Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to talk about impairments. All assets have the potential to be impaired at some point. An impairment can occur as the result of an unusual or one-time event. It could be the result of change in consumer demands, or maybe the damage to an asset. Assets should be tested for impairment regularly so the balance sheet is not overstated. The definition of an impairment is when an asset's fair value is less than its carrying value on the balance sheet. If a company impairs an asset, then that loss will be recorded on the income statement. An impairment will reduce the asset's balance on the balance sheet. Here's an example. ABC Corp. Purchased a building in January 2019 for $250,000. A fixed asset needs to be depreciated over time, so the cost of the asset is spread over many years. ABC Corp. Is depreciating the asset over 10 years, $25,000 a year. So on the company's income statement, they're going to record a $25,000 expense in 2019, 2020, all the way up through 2028. The carrying value or the book value that's reported on a balance sheet is going to decrease every year. So after the first year, the carrying value of the asset is $225,000, which is the original value minus the first year of depreciation. The second year, the value of the asset is $200,000, and it goes down over time as the asset is depreciated. Let's fast forward to 2022. So far, there's been 4 years of depreciation. So the carrying value is at $250,000 minus $100,000, 4 years depreciation. The value of this building on our balance sheet is $150,000. During 2022, there's a hurricane that causes damage to our building. After the damage from the hurricane, the company determines the value of the building is now $100,000. Since the balance sheet says the value is $150,000 and the market value is $100,000, we need to decrease the value of the asset on our balance sheet from $150,000 to $100,000 and pass through a $50,000 expense onto the income statement. Let's look at ABC's financials for 2022. So at the very beginning of the year, before the hurricane hit, this dollar amount said $250,000 for the building minus $100,000 of depreciation. The carrying value was $150,000. Once we impaired the value of the asset, we have to reduce the value in the balance sheet to $200,000. And we have to pass through a $50,000 impairment expense on the income statement. So let's look at this company's income statement. The revenue is $800,000, cost of revenue is $400,000, so gross profit of $400,000, operating expenses of $25,000, that was the depreciation, so their operating profit was $375,000. Let's pretend there was no impairment. So $375,000 is their pre-tax income, and they pay $75,000 of taxes. Now with the impairment, their pre-tax income goes down $50,000, but their taxes also go down. The reason they have lower taxes is because their pre-tax income is $50,000 lower. So they're paying taxes on a lower dollar amount. So even though the impairment reduced their net income, it saved them money in taxes. Their tax bill is lower. So the company's net income was $260,000. And when we look at the cash flow from operations section, it's net income, and then we have to add back the non-cash items from the income statement, $25,000 of depreciation and a $50,000 impairment. So the company generated $335,000 of cash flow from the operational business, yet they reported net income of $260,000. Because remember, the company paid for the building in 2019. They don't have to reduce the cash flow anymore. Depreciation and impairments are non-cash items. Let me give you a more extreme example. Let's say the impairment was $500,000. They bought a building for $1 million. Watch how this could really skew the numbers. So this company had the same exact gross profit and operating profit as before, yet they're reporting negative $100,000 of net income. But they're reporting positive $425,000 of operating cash flow. That just shows you how much impairments or other income and expenses can really skew the financials. To add a little more confusion to the situation, when you impair an asset, you have to revise the depreciation schedule. At the end of 2022, the value of the asset isn't $150,000 anymore, it's $100,000. So the new depreciation schedule is lower. It's $16,667 a year for the next 6 years. For the next 6 years, the company will pass through this amount of depreciation onto its income statement, unless, of course, there's another impairment. Impairment calculations can get a little complex, so I tried to use a basic one to give you the idea. If, for instance, in 2022, there was no hurricane, and say the value of the building was $300,000, we would not increase the value of the asset on the balance sheet. We would only decrease it. However, if you already impaired the asset and then in the future you value the asset higher, then you can increase the value of the asset on the balance sheet and pass through the gain onto the income statement. Maybe in a future video I'll go through the math on that one. Try to think of it really high level. The purpose of impairing assets is so you don't overstate the value on the balance sheet. It would not be correct to say to investors, we have $930,000 of assets if they're only worth $500,000. That's why companies should make sure the assets on the balance sheet are recorded correctly, because the company could get in trouble for inflating its balance sheet and deceiving investors. And remember, impairments and depreciation are separate things. Depreciation is a predetermined amount that the company passes through as an expense onto its income statement and deducts the value on the balance sheet. Impairments account for an unusual or drastic drop in the fair value of the asset. The purpose of depreciation is to account for the wear and tear of an asset. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to become a member, you can click the link in the description below. Thanks for watching.